Hello, and you're welcome to Global Business Insights, where we cover details on the main stories from the business perspective. Tesla's shares are spiking up as we speak, up 17.7% as investors welcomed news that local Chinese authorities had removed restrictions on its cars after passing the country's data security requirements. This raised expectations that Tesla's full self-driving software FSD would soon be available in the country, which is the largest market for electric vehicles. Germany Consumer Price Index came in unchanged at 2.2% on a yearly basis in April, below the market expectation of 2.3%. On a monthly basis, the CPI rose 0.5% after a 0.4% increase recorded in March. We replay the clip on President Bola Tinubu, who yesterday justified removal of fuel subsidies in Nigeria and explained efforts currently being made by his administration to manage the foreign exchange market. This he did at the opening of a 2-day special World Economic Forum in Riyadh, Saudi Arabia. Later this week, in the US, the Federal Reserve Committee meeting holds. This time, analysts have shifted as they listen for clues from how many times interest rates could be cut this year to whether to even expect rates to be cut at all. BHP is in discussions on a revised bid for Anglo American after its $39 billion initial proposal was rejected by the London-listed miner. The revised bid could come anytime this week. We also replay an earlier clip on how businesses all over the world are responding to the imperative for resilience as supply shocks look set to intensify. But first, Lukman Otunuga speaks on appreciation of the Nigerian Naira and speaks on sustainability.
The Naira hit a 4-month high at the official foreign exchange market last Friday as dollar supply increased after the holidays. The local currency's recent appreciation against the hefty devaluation earlier in the year is a breath of fresh air and something that has boosted sentiment towards the largest economy in Africa. A raft of measures can be thanked for the Naira's increase, including the Central Bank of Nigeria raising interest rates by a cumulative 600 basis points between the February and March meeting, as well as other steps to ease the local currency's scarcity of dollars that fund volatility and also forced companies to the parallel market. Nevertheless, the main risk from the currency's incredible appreciation is that of possible public backlash and the failure of local businesses to potentially adapt quickly to such rapid and aggressive changes. Still, the Central Bank of Nigeria's external reserves have fallen to its lowest level in 7 years at 32.1 billion. This is the fastest rate of decline since the peak of COVID-19 4 years ago. Even though the dip in reserves coincides with the Central Bank of Nigeria disclosing that it's fully reserved all its substantial FX liability backlog, this is something that needs to be really closely watched. Another question is whether the supply of dollar will prove sufficient to support the central bank's goal to boost confidence in the Naira in the medium to longer term. More time may be needed to see whether the Naira will continue to appreciate, especially when factoring how inflation in Nigeria kept climbing in March, reaching a near 30-year high of 33.2%, driven by soaring food and energy costs, despite the Central Bank of Nigeria's effort to continue hiking the interest rates to support the Nigerian Naira.
The recurring theme on the mind of businesses who want to stay ahead could be how to build resilience in light of the tougher external context. And this cuts across the continents in a situation where none are immune to the impact of external developments in an increasingly more integrated global economy. When you compound uncertain geopolitics with structurally higher cost pressures, interest rates, and all the macroeconomic volatility, you could find operating models, assumptions now obsolete, and the need to rethink dimensions of doing business to stay competitive and profitable becomes imperative. According to a study by Analysts Data Services and Resources, that's in Nigeria, on the resilience of Nigerian firms over the global financial crisis of 2007 to 2009, the 2016 recession, and the COVID-19 pandemic in 2020, businesses in the financial and industrial sectors were the most vulnerable, while the agriculture and trading sectors were more resilient. But as global integration interlocks more Nigerian corporates with international supply partners, the future environment presents more vulnerabilities than the past. In its latest study on the topic, Accenture concludes that after decades of cheap liquidity combined with low and stable inflation, they see a fundamentally different era where supply scarcity is set to become the main driver of economic outcomes. This will, however, create opportunities for those able to build resilience against these pressures, thus gaining competitive advantage. The next 5 to 10 years could be years of tighter supply in credit and liquidity, labor and energy and commodities. Accenture also sees a trend of growing trade frictions and retreat from globalization, constraining access to key factor inputs. And the fragmentation of global production and trade is eroding the previously low friction flow of labor, of goods and services, energy and finance around the world. The result will be margin erosion, volatility of input costs, inflation, of course, and intensifying financial and market valuation pressures. All this on top of more complex supply chain management challenges with more potential points of failure. Now, what can companies do differently? Starting afresh with fundamental cost reinvention to fortify the business model against margin erosion becomes a good idea. They can also consider new levers like artificial intelligence, robotics, and automation, as many are already doing, to push up productivity in a difficult time. Companies also need a plan to navigate the growing labor supply pressures and skills gaps as the war for talent intensifies. Companies may also want to explore improving government relations capabilities and industry partnership frameworks to leverage government support for onshoring, nearshoring of production and supply. In the new environment, governments are playing a bigger role to create jobs and economic growth. Already, global markets are separating winners from losers and interpreting narratives on the basis of how companies are able to defend themselves, also at a time when balance sheet buffers and fundamentals are also becoming more important for price valuations.
Concerning the question of the subsidy removal, there's no doubt that it was a necessary action for my country not to go bankrupt. One, to reset the economy and the pathway to growth. It is going to be difficult, but the hallmark of leadership is taking difficult decisions at the time it ought to be taken decisively. That was necessary for the country. Yes, there will be blowback. There is expectation that the difficulty in it will be felt by a greater number of the people. But once, I believe it was their interest that is the focus of the government. It is easier to manage and explain the difficulties. Along the line, there is a parallel arrangement to really cushion the effect of the subsidy removal on the vulnerable population of the country. We share the pain across board. we cannot but include those who are very vulnerable. Luckily, we have a very vibrant, youthful population interested in discoveries by themselves and highly ready for technology, good education, committed to growth. We were able to manage that and partition the economic drawback and the fallout of the subsidy removal. Equally, it engendered transparency, accountability, and physical discipline for the country.
Nigeria is doing almost everything in the IMF rulebook on subsidies, more driven by proximity to bankruptcy than any other factor. Removing subsidies definitely creates fiscal space for better targeted social spending, reductions in inefficient taxes, and productive investments, which will promote sustainable and fairer outcomes. Fossil fuel subsidy removal can also reduce energy insecurity concerns related to volatile fossil fuel supplies, as better prices attract investments, especially in the era of energy shortage. My take on producer subsidies is that productivity improvements and removing barriers to competition are absolutely critical as remove subsidies so that already impoverished populations are not paying extra for inefficiency, for unnecessary cost overloads and wasteful governance, poor decisions and structures which are passed on into cost of energy, electricity or other inputs. Pushing subsidies without addressing productivity and governance reform places unjust burdens on the population, which they have no reason to bear, and often could be the root cause of all the societal pushback to subsidies, which of course potentially leads to a higher risk of policy reversal.
Capital formation that is necessary to drive the economy, like agriculture, food security, innovation, technology advancement, must be an inclusive program of the entire world. No one should be left behind.
On capital formation, the president is spot on. No country should be left behind in capital flows in terms of having enough to develop their own economies, rather than the situation we see now where less developed economies are penalized with high risk ratings. Others are now talking about canvassing for debt forgiveness as reparations for past centuries of exploitation. But we must also admit that while there is some capital that can move to address inclusivity or even reparations, most capital will always be attracted to economic efficiencies, decent yields, good governance, macroeconomic stability, and plugged leakages, rule of law, and order. Oil prices continue to slide, erasing gains from Friday as Israel-Hamas peace talks in Cairo eased fears of a wider conflict in the Middle East. Brent crude, as we speak, is down 1.11%, under $89, $88.51. European stocks are mostly higher, somewhat mixed. Well, that's it from me on Global Business Insights. This is Bode Oshosami. Please share, kindly follow on Facebook and LinkedIn, subscribe on YouTube and X. Thank you very much.